Hello and welcome back to another video. Today we're going to be looking at both personal loans and car loans, and I'm going to be comparing them both so you know which one is a better option for you to use. Now in this video I'm going to be fully explaining them, and I'm also going to be going over the pros and the cons. So by the end of the video you're going to understand everything you need to know about personal loans and car loans, and you're going to know which one is a better choice for you. So to start with, personal loans. A personal loan is a type of loan that can be used for a variety of purposes, such as paying for home improvements, consolidating debt, or covering unexpected expenses. Personal loans are typically unsecured, which means they are not tied to any collateral. This means that the lender cannot repossess any of your assets if you default on the loan. However, it means that the personal loans typically have higher interest rates than secured loans. Personal loans can be obtained from a variety of lenders, including banks, credit unions, and online lenders. The amount of money you can borrow and the interest rate you'll pay will depend on your credit score, income, and other factors. Personal loans are typically repaid over a period of 12 to 60 months, and your monthly payments will be based on the amount of money you borrowed, the interest rate, and the repayment term. So what about car loans? A car loan is a type of loan that is used to finance the purchase of a vehicle. Car loans are secured loans, which means that they are tied to the car that you are purchasing. This means that the lender can repossess the car if you default on the loan. Car loans typically have lower interest rates than personal loans because the lender has less risk. Car loans can be obtained from a variety of lenders, including banks, credit unions, and car dealerships. The amount of money you can borrow and the interest rate you will pay will depend on your credit score, income, and the type of car you are buying. Car loans are typically repaid over a period of 24 to 72 months. And your monthly payment will be based on the amount of money you borrowed, the interest rate, and the repayment term. So what are the pros of personal loans? Personal loans offer a number of benefits, including flexible use. Personal loans can be used for a variety of purposes, such as paying for home improvements, consolidating debt, or covering unexpected expenses. They're also unsecured, which means that you do not need to put down any collateral. And this can be helpful if you do not have any assets to pledge as collateral. There's relatively quick funding, and this is typically within a few days. This can be helpful if you need money quickly to cover an unexpected expense. And it also may help improve your credit score. Making on-time payments on a personal loan can help to improve your credit score, and this can make it easier to qualify for other types of loans in the future and get better interest rates. So what about the pros of car loans? Start with lower interest rates. Car loans typically have lower interest rates than personal loans or credit cards. And this is because car loans are secured loans, which means that the lender can repossess the car if you default on the loan. There's also longer repayment terms. This can make the monthly payments a lot more affordable. There's flexible down payment requirements. Some lenders may offer car loans with low or no down payment requirements, and this can make it easier to afford a car even if you do not have any money saved up. And finally, there's a potential to build up credit. Making on-time payments on a car loan can help build your credit score, and this can make it easier to qualify for other types of loans in the future and get better interest rates. So what about the cons of personal loans? To start with, higher interest rates. Personal loans typically have a higher interest rate than secured loans, such as mortgages and car loans. This is because personal loans are unsecured, which means that the lender does not have any collateral to repossess if you default on the loan. There's potential for fees. Some lenders may charge fees for personal loans, such as origination fees, late payment fees, and prepayment penalties. It is important to compare different lenders and their fees before you choose a loan. There's an impact on your credit score. Taking out a personal loan can have a small impact on your credit score, and this is because it will increase your total debt load. However, making your payments on time will help to improve your credit score over time. And finally, they may not be suitable for everyone. Personal loans are not suitable for everyone, so if you have a lot of debt or a low income, you may not be able to qualify for a personal loan or afford the monthly payments. So how about the cons of car loans? To start with, there's a risk of negative equity. If the value of your car depreciates faster than you're paying down the loan, you may end up with negative equity, which means that you owe more on the loan than the car is worth. This can make it difficult to sell the car or trade it in for a new one. There's potential for fees. Some lenders may charge fees for car loans, such as origination fees, late payment fees, and prepayment penalties. It's important to compare different lenders and their fees before you choose a loan. Just like personal loans, there's also an impact on your credit score, but making your payments on time will help to improve it over time. And finally, it may not be suitable for everyone. If you have a lot of debt or a low income, you may not be able to qualify for a car loan or afford the monthly payments. So which one's right for you? Whether a personal loan or a car loan is right for you depends on your individual circumstances and needs. Personal loans are flexible and can be used for a variety of purposes, such as consolidating debt or covering unexpected expenses. However, they typically have higher interest rates than car loans. Car loans are specifically designed to finance the purchase of a vehicle. They typically have lower interest rates than personal loans, but they require a down payment and have a longer repayment term. It is important to shop around and compare different lenders before you take out any type of loan. You should also carefully consider your financial situation and make sure you can afford to make the monthly payments. If you're still unsure which type of loan is right for you, you may want to speak with a financial advisor. They can help you assess your needs and choose the best loan option for your situation. So that's been my video comparing personal loans and car loans. Hopefully now that you've watched this video, you should understand everything you need to know about both of them, and you should be able to make an informed decision on which loan is a better choice for you. Now, if you did find this video helpful, please comment down below to say this video helped you out, and also like and subscribe for more content like this. Thanks for watching.